there's going to be advisors that read the, see the writing on the wall and start reaching out to everybody that's, worth around $5 to $10 million bucks. Are you going to be that advisor, that planner that reaches out before that gold rush, that starts actually planning now?
4, 3, 2, go!
Hey, welcome back to the Ready, Set, Grow podcast. We are your life insurance beards. This is Drew. This is Chris. And, we get to talk about something extremely exciting today, taxes. Taxes is going to be a huge conversation that you have with your office, with your clients, probably with anybody that you run into, especially during a presidential election cycle, which has already been pretty incredibly wild, right?
Fun to watch.
Yes.
Let's just say that.
It's definitely entertaining.
Never seen this type of cycle in my life. Though I've only seen like 4. So, I'm not a great judge, but it's been very exciting.
God bless America.
That's right.
But Chris and I get to talk about taxes, and it is going to be an important conversation. Not only are we going to hear it over the next several months, but obviously just with your clients, because there are some pretty big implications and some big things happening that you're going to want to address, right? So, Chris, really in the grand scheme of things, like what is really the main importance of just tax planning in general? Why are you going to be talking about it with your clients, and why is it so important right now?
Thank you, Drew. Appreciate that.
No
before I get started, I do want to recognize that we are in fact back. I wasn't surprised when the first episode we did got 100% certified fresh on Rotten Tomatoes. So that's fantastic. But yeah, the importance of tax planning. What we've seen broadly, you and I have been in this business for forever. I've been here for 12 and a half years. You've been in the industry for 2 decades, right?
What's up that? I'm not that old, but sure.
Yeah, let's round up 2 decades.
Sure.
So, one of the things that, we've noticed about taxes is when you lead with a tax conversation, you not only are able to access a higher net worth clientele, both in your normal marketing initiatives, but you're also able to close bigger cases, both on the annuity side. You might be able to capture more assets from an assets under management perspective, and you might be able to write that, wink, wink, big life insurance case to protect their principal and grow it tax-free. We'll get into that in a second. But that's really the importance for advisors from a selfish perspective. Now, from a selfless perspective, from a client value perspective, at the end of the day, it's really important to take a look at taxes for your clients, because clients don't necessarily realize, and gotta be honest, I don't think some advisors realize this either, is that reality happens post-tax. It's not about what I see in my account. It's about what I put in my pocket after the IRS has its say, right? So that $100,000 in my pre-tax account might actually only be $60,000 when the IRS, takes what they think they are owed. So, I think it's not just a benefit to advisors to stand out, to generate more high net worth clients, to attract higher accounts and close larger cases, but it's important for clients to understand the effects of taxes, especially on their distributions from their pre-tax accounts, but also when it comes to Social Security benefits or pension income, right? A lot of folks don't understand that Social Security can be the most highly taxed income that anybody ever experiences in their entire life.
To a significant amount.
Because of the way the federal government have figured out to say, we're going to claw back some of this money back that you've paid into. We're still, wink, wink, going to claw some of that back with these cute little marginal tax rate calculations we use that no one on Main Street understands, right? Rant over. I'm off my soapbox. Sorry about that. But yeah, it's like, I don't think that folks really take into account how important it can be.
Yeah. And it still remains one of the biggest fears in retirement for consumers too. So, you have to have the conversation. So switching gears a little bit, and I am going to encourage you to use your best Trump voice here, because his tax cuts do expire
Bigly.
They expire
terrible.
here in
That
a
was
couple
terrible.
of years, right? We're in an election cycle. So what are the effects of the potential tax cuts sunsetting? Are they going to go up? Are they going to stay where they are? Is
Yeah.
it political suicide to not keep them down? Like what's the landscape there over the next couple of years?
Well, we don't really know. I mean, all we really do know, and I'm sorry for that bad Trump impression earlier. I'm not going to do any more.
Why not? We're on
I
camera now.
think
You gotta let it loose.
I think we might get copyright struck by his team, and I don't want to deal with that. I'm pretty sure he's copyrighted his voice at this point. But yeah, I mean, with the sunset, and starting January 2026, we are going to see a fundamentally different tax landscape, both from an income tax perspective and from an estate planning perspective. Now, there's a lot of other things in there that might actually help families. When these Trump tax codes go away, they're bringing back the child tax credit. That could really help working families, people that have kids, a lot of kids especially. But for a lot of folks that don't fit in that specific group, and this includes business owners, this includes just middle America, they will be paying a higher amount of taxes. What I was noticing, I encourage anyone listening to this, if they don't already know, go and check out what the tax rates are likely going to be, come 2026 when those tax cuts sunset. Largely, clients in the middle brackets are going to be hit the hardest. Yep. Folks that, and this is important, folks that are considering Roth conversions, converting that IRA money to a Roth to insulate it against further taxation by generating a tax-exempt income from that Roth IRA. People, I don't think, understand that their taxes will likely go up between 5 and 7% just on the federal level, right? So you're talking about spending on every $100,000 that you're converting an extra $5,000 to $7,000 in taxes, right? So the time to talk about Roth conversions and get ahead of that changing landscape is now. Yep. And that's just from an income tax perspective. I mean, we're going to see folks paying higher income taxes broadly across the board. We're going back to the Obama era tax rates, which still, even though it's going to be worse than where we are now from an income tax perspective, it's still better than 95% of all the years.
Yeah, when you look back.
If we look at the history of the American tax code, the Obama administration was better than 95% of all. And I'm not trying to get political here. We already brought up Trump. Bring up Obama. We're going to find a nice middle ground to unite America. We're going to unite America on this
So
podcast.
It starts here on this podcast?
It starts right now
Okay.
on this episode. We're going to get I think we might get the first 110% certified fresh on Rotten Tomatoes. I'm very excited about that. But, when you look at the actual tax history of the United States, we see years of, drastically higher taxes than what we saw even in the Obama administration. So tax rates are going up. And that's the main message you got to bring to your clients is tax rates are going up. What is our tax plan? How are we going to address this issue? Then, of course, we introduce the estate tax issue, right? I mean, you and I being in our position, getting an estate tax case, where we're planning for a projected estate tax is a great case.
Yeah.
Because we get a high net worth person. We get the sign off of an estate attorney backing us up. We got these products that are simple and easy and it makes sense. But that went away. For the last 4 years, we really haven't had 4 or 5 years. When did it go, in fact? Who cares? But we really haven't had those conversations as much because that estate tax exemption went up to $22 million and change, right, for married couples. So now we're seeing what I would consider a return to normalcy, at least for our adulthoods. I mean, folks don't have to go back very far in like 90s to see $1 million estate tax exemption, right?
Imagine the business if that's what it still was.
Boy, I wouldn't be talking to you right now, man. Why did I just turn into a Southern preacher? What happened?
I don't know. Let's see. Trump, maybe an Obama impression later. I don't know, but
we're not doing that.
Preacher, it does run in the family.
That is true. I got it in me. It's in my bones. But when we're talking about the estate tax, I think it's really important because those clients that might be on the cusp, right? Maybe you, speaking to the advisors on listening to this right now, hey, happy to see you. When we're actually talking to these clients that are on the cusp of needing estate tax planning now, where estate tax exemptions are now, they're going to definitely need it in 2 years.
That's right.
Right? Well, actually, it's less than a year or less than
It's
2 years
really
away,
close, yeah.
a year and a half. But those folks, we're going to see a renewed vigor in the estate planning market space, I think, in the future, because of these changes. And honestly, there's going to be kind of a gold rush for that, right? There's going to be advisors that read see the writing on the wall and start reaching out to everybody that's, worth around $5 to $10 million. And so are you going to be that advisor, that planner that reaches out before that gold rush, that starts actually planning now for that contingency and really talking about it before everybody else does?
Yeah. And those products are looking better now, probably than ever before too, just from a
Yeah.
pricing standpoint. So not only are you probably going to have more opportunities, but the products are better than ever, and getting ahead of it now is going to be important.
Yeah.
Everybody we speak to from an advisor standpoint has the clients that are going to fit this mold. So
Absolutely.
you're right on the gold rush, and the earlier you get in front of it and start talking about it, I
Yeah.
think the more credible that you're going to look from an advisor standpoint, right?
Yeah, absolutely. And I think, the big thing with advisors that maybe aren't used to this type of high net worth planning, maybe they have somebody that they know is worth over 5 million, but maybe they have an annuity or two, maybe they manage some of their money, maybe they have a life policy on them. Just they wanted to get a piece
Yep.
of that total cake. I think being able to lean on us, being, in our positions where we see estate tax cases every month, even after the Trump tax codes went into effect. I'm still seeing a case every month, every couple of weeks, depending on, the advisors I'm talking to. So we have the experience, we have the modeling, we have the software we can use to figure out, hey, what's your estate tax liability? How do you talk about it? What are the opportunities that you might be able to develop as a result of just going down this estate planning pathway? The big low-hanging fruit is developing a relationship with an estate planning attorney, referring high net worth folks to that attorney, and in return getting referrals on financial advisory matters from that attorney. So starting to build that sphere of influence in those key kind of relationships that we might have not thought about doing because we've been intimidated to talk about.
Yep.
Right.
Well, it just hasn't needed to be a conversation,
Right.
Quite honestly. So
Yeah.
I'm going to switch gears on you again because, the next, I think, talking point I just want you to spend a couple minutes on. And as you guys will notice, like, you're kind of the brains of this operation, right?
That's not true.
Your mind works significantly more intricate than mine when it comes to these types of topics, which is great.
ways.
So something else has just come down over the last couple of weeks is the Connolly decision.
Yeah.
Like, what the heck is it?
Yeah.
And like, why is that important?
Yeah. So this one's still basically the Connolly decision came about because of two brothers. One passed, had a majority stake in a business. They had a buy-sell in place. That buy-sell paid out just like every other buy-sell would on a cross-purchase buy-sell, right? For those that are not familiar with buy-sell, like a cross-purchase, it basically just means that, hey, surviving business owner or partner, in this case, is going to buy out the family of the deceased business partner, right? Pretty cut and dry stuff. I don't want to be doing business with my partner's family necessarily.
Right.
They might not have the same vision of the company in mind. They might candidly just be a bad business partner. So, that's the whole purpose of a buy-sell. And it was a majority decision by Justice Clarence Thomas that came out that essentially said, those buy-sell agreements that actually might have to be included as part of the valuation of the business and might therefore also be subject to an estate tax issue when it's tied back to the business partner in question on a personal level. So now we're talking about fundamentally changing how buy-sells work. In the past, buy-sells have not had to be a part of business valuation, right, for tax purposes. Now they are. And that has a cascading effect in your clients, your business owning clients' personal income and estate tax picture. So I think what we're going to see as a result of the Connolly decision, and we're already seeing it now. I mean, Lincoln came out with a great white paper around it. It's a really good study on just the basics of why this will change things. And I think we're going to see a lot of advisors going back to business owning clients saying, hey, remember that, that buy sell we put in place? Let's re-examine that. Let's make sure that we don't have a corresponding plan in place to offset any potential estate tax issues or, any ramifications that could have come about because of this decision. So yeah, I mean, that I think it's going to be another big opportunity for planning in, 2024 and beyond in the business owner market space.
Yeah. So if they need anything regarding the Connolly decision, they could reach out to us.
Yeah.
Again, Lincoln's white paper,
It's great.
we have access to. We can get it over to them.
Right.
So kind of to end everything here, Stonewood Financial is a big partner of ours, huge from a tax planning standpoint. Can you touch on a couple of just quick high points of the importance of Stonewood and what advisors need to do to get in contact with us regarding them?
Yes, Stonewood, the tax titans.
They are.
The Lions of Louisville. I don't think that worked, but I was trying something different.
You almost went Trump.
I did kind of.
It was close.
Yeah. So that basically Stonewood is a relationship we've been working with for the better part of 3 years. They were actually started by financial advisors, which is really cool because a lot of times you get a software or a service or a planning concept that's developed by someone that has no experience talking to humans across the table, right? And I think that's, that having Stonewood be something built by financial advisors that are still actively writing business is kind of what, one of the things that sets them apart. But Stonewood is a great company. They've been a great partner of ours that specializes in tax planning, right? And more importantly, specializes in making tax planning accessible for everyday people.
And easy to understand.
Right. I think when you're out there talking about, the main perception people have around taxes is a CPA, right? That nerd with glasses, maybe has a beard, wearing suspenders or something.
Striped shirts.
You thought I was talking about myself, but I had a little curveball there.
It was easy target.
Okay, thanks. More balding than me, probably. Maybe.
I don't think you want to turn around for the camera, so it's okay.
But so, I think there's a perception of like tax planning bad, tax planning confusing. Not to say that everyday people speak like cavemen, but they, that I think that's a perception out there is that, I don't want to deal with it. I want to have something that's going to generate tax exempt income. I would love to have something that gets the IRS out of my retirement portfolio, but I don't know how to do it. I'm scared on the rules and I need some guidance and something to make it simple. And Stonewood has really developed a ton of marketing collateral around this. I mean, they have, soup to nuts, tail to snout, snout to tail. Anyway, they have a great marketing funnel that goes over, that starts with starting the conversation with white papers, brochures, collateral that you can use in email drip campaigns, radio, video scripts. You have on-demand seminar presentations that you can do as a webinar to your current book of business, all encompassed around this idea of how do we make your portfolio more tax efficient? How do we make it more risk efficient? How do we make sure that we're maximizing your retirement income by integrating these tax-free strategies? And, the ultimate thing, like it leads the client down this pathway that's easy to understand around, hey, I actually have the power to do this. Hey, I can do this. It's not as complicated as I thought when I have an advisor that knows what they're doing and makes it simple for me.
Yep.
And so I have advisors that are using that with clients every single day. They might be talking about using, a lot of the software talks about, tax burden, looking at, hey, how much taxes are you going to pay on an IRA? through your age 90 versus what happens if you convert it now to a Roth? What happens if you insulate that money against further taxation? Do you save money in taxes long term doing it that way?
Or are you just compounding your problem?
Exactly.
Yeah.
Right. And I think that's easily leads into a planning strategy that you can talk about assets under management. You can talk about fixed index annuities with a Roth conversion strategy. Ideally, you're also talking about using a principal protected IUL as a kind of Roth IRA alternative for a portion of the money. Because of the magic of that policy and that product being able to do things that just other products can't. But ideally, you're looking at all three of those, putting a portion, once you really paint that tax picture, you're able to capture more assets.
Yep.
And you're going to capture more AUM, FIA, and maybe some life insurance along the way.
Which is ultimately the goal. Right. So the conversation's there, the opportunity's there. If any advisor needs help, needs an additional resource, that's what we're here for.
That's right.
Whether it's from a carrier, whether it's from Stonewood, it is going to be an important conversation, and that's what we're here to help them do. And so taxes, again, it's going to be an important concept. Make sure that you're getting out in front of it before it's too late, or before another advisor sneaks in and kind of steals your thunder.
Yeah.
Right.
The volume we're going to see is going to continue to increase around the tax law changes.
That's right.
And, we make hay while the sun shines.
Yep.
And right now the sun is shining.
Time is now.
Yep, exactly.
So for more content like Chris and I just shared, make sure that you are following the Impact Partnership YouTube channel. You can check out videos of like house rules from our Chief Marketing Officer, Alex House, Selling with Stories with Randy Cook, or just general podcasts like Chris and I do. There's a ton of resources out there for you. Make sure you're following and benefit just like other advisors are doing every single day.
Hit the like.
Hit the like button.
Notifications too.
Subscribe.